thank you so much for the organizers for including the paper in the conference. I'm going to take you back a little bit over 100 years. And we're going to talk about real effects of financial crises during the panic of 1907. There is a fairly large macro and micro literature looking empirically at the real effects of crises. So in recent years, economic historians and economists have amassed long-run data on crises. And what we find is that there is a pretty strong correlation from financial crisis to the severity and the duration of economic recessions. Now, from this macro evidence, it's a little bit hard to know whether this correlation is causal or not. So how much of the economic decline that we see is really attributable to the financial crisis and how much is due to other sources. There is, on the other side, a different literature. So this is the diff and diff sort of identification police that looks for micro-level evidence of the effects that a contraction in intermediation has on the borrower's outcomes. And sort of that's a literature that's sort of trying to tease apart the credit channel, but by identifying how much is the effect from changes in supply of credit rather than the demand for credit. Now, in this literature, mostly what we've seen is that papers to try to obtain this identification have focused on crises that are transmitted internationally, where the country where we analyze is not directly affected, or that are crises that they're not crises, but where we see a particular institution failing or suffering. There are a few exceptions there. All of the papers in this literature exclusively have looked for transmission within the regulated financial institutions. My sense is that that's because it's where we have the data, mostly. And another characteristic is that these are sort of diff and diff estimates where we're comparing to, a firm to a different firm, an affected firm to an unaffected firm. But most of the papers in this literature don't usually try to sort of aggregate these diff and diff effects to say something about sort of the macro effects. There are a couple of exceptions, and these exceptions look at the aggregate effects on employment and sort of the effect of the credit channel on exports at the economy level. So what is it that we're trying to do in this paper? Well, we're going to look for evidence of the effects of the transmission of a domestic financial shock. So this is a financial crisis where we're going to look at the effects within the country, in the US, has on the outcomes of non-financial firms, and where the transmission of the shock is going to be happening through what I'm going to call the early shadow banks. And these are the trust companies that Guillermo, I'm very impressed, made a reference to yesterday. So this is going to be a shock that's going to come from the financial institutions that are very lightly regulated and that did not have access to any sort of lender of last resort at the time. Now, especially when you go to historical data, it becomes pretty hard to separate credit demand from credit supply in sort of the standard way that you just saw in the previous paper, where we can see the same firm borrowing from different banks and so on. We don't have that kind of data. So the panic of 1907, it's quite unique in the way in which the panic started. And that's going to allow us to argue that what we're going to be picking up, it's going to be mostly the effect of supply and not of demand. So I'm going to try to convince you that the shock that we have to financial intermediaries, it's coming from a different type of identification that's based on personal connections that had nothing to do with the characteristics of the borrowers, the non-financial borrowers of those financial firms, okay? And we're going to look for effects at the firm level. One of our variables of interest is going to be investment, and then we're going to use these diff and diff estimates to sort of try to build up an estimate of how much the aggregate contraction in investment, in corporate investment, we can attribute to this financial shock, okay? So I'm going to be talking about the panic of 1907. This was not a small crisis. It was one of the major financial crises before the Great Depression in the US, and it's a particularly interesting one. I won't have time to really do it justice, but in the paper we describe a lot why I think it has very interesting parallels with the recent financial crisis. So if you're looking for a historical parallel, the panic of 1907 is a good place to look. So whether these early shadow banks are what were called trust companies at the time, trust companies were financial institutions that appeared in the 19th century mostly as a vehicle originally for wealthy individuals to leave their money in trust. But starting in 1890, roughly 15 years before the panic, they really grew and expanded, particularly in New York. They took on a lot of the roles that commercial and investment banks were doing at the time. By 1906, they were lending the same amount that national banks in New York were lending, so they were a big part of the financial sector. They were acting as financial agents, they were lending to firms, they were underwriting for firms, they were really competing with banks, okay? They grew much faster than banks, to a large extent because they were not quite as regulated as national banks were. National banks at the time had a 25% reserve requirement. Trust companies had no reserve requirement until 1906. And in 1906, a 15% requirement was imposed, of which only a third had to be held in liquid assets. So very, very lightly regulated. And the way in which, I think one of the reasons why they tried to argue out of this regulation for so long was to say that they were not exposed to the sort of standard sources of systematic risk that banks had during the national banking era, which came from the agricultural sector that would withdraw resources and then it would trickle down from the national banks in New York. Okay, so they argue they were not exposed to systematic risk in a way, and they got away with it for a long time and were very lightly regulated. The other aspect that's going to be very important is that they didn't have a sort of lender of last resort. Now, the panic of 1907 is the panic that gets the US over the hump to establish a central bank. So there is no Fed, right? There is no lender of last resort. So what national banks would do is they would fund private organizations, which were clearing houses, that they would clear for each other, but they would also serve as a way to coin-share each other during crises. So they were extremely important during crises. Trust companies in New York could have cleared through the clearinghouse through a member, okay? So they could have participated in this. In 1903, though, the clearinghouse imposed a reserve requirement to be held in cash for trust companies to be able to clear. Most of them, they did not want to do this, so they decided not to be part of the clearinghouse, okay? So by the time of the panic, they're very lightly regulated, and they're not part of the clearinghouse. And that's going to create a lot of trouble, so the crisis that I'm going to tell you is going to sort of, in New York, particularly affect the trust companies. So what is it that we're going to do? We'll do a lot of things in the paper. We'll see how much I can cover. But I'm going to start by telling you sort of historically, but also showing you empirically, that the degree of deposit losses that these trust companies suffer is actually related to a speculation scandal that happens in the financial markets that has nothing to do with the borrowers from these trust companies, with the non-financial firms. And that's important because it's going to appease these reverse causation concerns that what we're picking up is really demand for credit rather than supply for credit, okay? Now, once we do that, if I convince you of that, then I have to link the financial firms to the non-financial firms. So the way in which we're going to identify connections is by boards of directors. So pretty much every single data point you're going to see in this paper was hand-collected for it, okay? Forget about CompuStat, CRESP, or anything like that. It doesn't exist for this period. So what we did is we collected data of the boards of directors of industrial firms and railroads, and then used directories of banks to identify whether there were bankers on the boards of these firms, okay? And we also collected this sort of as standard financial information as we can have for all NYNC listed industrials and railroads. So we have 125 firms. So once we establish the connections, we're going to look first for firm level effects, and we're going to do a comparison of the effects on non-financial firms. So this is a diff and diff setup that are connected to affected trust versus those that are not. And we're going to find that being connected to unaffected trust, and by that I mean a trust that lost a large amount of deposits during the panic, affects the stock market performance and affects their profitability, their investments, the dividends, and so on. And then we're going to grab the estimates for investment. We're going to try to look for aggregate effects. So we're going to do two things. One thing is we're going to look for the duration of the effects. Okay, so how long are these effects triggered by this shock to the supply of credit on them? And we're going to find that the impact is roughly 3 to 5 years, at least from what we can see. And then we're going to aggregate these effects. And I'm going to show you that at least about 18% of the total contraction in corporate investment in the US in 1908 can be attributed to these connections to trust companies. So sizable, okay? If I have time, I'm going to come back to mechanisms. So I've been talking a little bit about credit supply, but you can already see that the way in which I can connect trust companies to financial firms is not by how much they're lending to them, it's whether they have a board interlock. Okay, so I don't see whether they're lending or underwriting for them. We don't have such a nice data set. So there are two possible interpretations for our results. One is that what we're seeing, this contraction in investment and so on, it is really evidence of a credit channel. Okay, so that when the trust companies are affected, they cannot provide financial services, and there is some stickiness in these non-financial firms to find other providers, at least for a while. But the other possibility is because the panic has to do with a scandal where some directors now appear to have been sort of involved in malfeasance, another possibility is that affects the reputation of the non-financial firms as well. And so that might be another channel, if you want more sort of a balance sheet type of channel that might affect firms. If I have time to show you this, we provide some suggestive evidence that what's acting is the credit channel. So that's the way in which I'm going to frame my presentation. But we can come back to it later. And again, if we have time, I'm going to sort of try to convince you that even with all of the fixed effects that we add, what we're finding is not driven by a selection of the non-financial firms into relationships with trusts due to some unobserved characteristic that's actually time-varying, for which we cannot control with fixed effects. Okay, so that's the plan. So let me tell you something about the panic. The panic, what triggered the panic, so there was instability in the markets, but what triggered the panic was that a series of crooked bankers took control over a series of small national banks. This is going to be important. They used the resources of those banks to speculate, so to corner the shares of a copper company. This failed miserably. The resources of these banks were in trouble. Runs started on some of these commercial banks. And what these commercial banks did, so these national banks were members of the clearinghouse. They went to the clearinghouse, and the clearinghouse said, fine, I'm going to give you liquidity, which actually did stop the runs, so they did not suffer. But all of these individuals have to resign very publicly from all of the national banks that are members of the clearinghouse. So here are the members that, some of the most prominent members involved in the speculation, and you can see 3 of these banks really suffer runs, okay? And if this is all that had happened, because of the injection of liquidity, maybe the crisis would not have evolved in the way that it did. The problem was that Morse was a well-known connection to Charles Barney, mostly through the National Bank of North America, and Charles Barney was the president of Knickerbocker Trust, okay? So although the runs stopped on the national banks, they trigger to Knickerbocker. So Knickerbocker started losing a lot of deposits. So 2 things happened in October 21st. The clearing agent, so Knickerbocker is one of the few trusts that actually does have a clearing agent, says, we're not clearing for you anymore. Okay, so you don't get access to the resources of the clearinghouse anymore. The second thing is that they fire the president, Charles Barney, explicitly for his connections to Morse. So clearly to the scandal. Big run on Knickerbocker, okay? They go to the only person that can help them, JP Morgan. Within half a day, JP Morgan gets the books of Knickerbocker. Knickerbocker is the Lehman of the panic of 1907. Okay, within half a day, they say, well, we don't know whether this company is sound or not. They let it fail. When they let it fail, this is chaos. And the crisis basically triggers to a lot of the other trust companies in New York, which now learn 2 things. First of all, there is some possibility that their directors are connected to a scandal, and if they're in trouble, the clearinghouse won't help them, okay? And they cannot do what national banks could do, which was to suspend convertibility and to use the resources of the clearinghouse as a lender of last resort. So, which is actually what national banks did in New York. They suspended convertibility and they issued certificates of the clearinghouse in the way that sort of Gardy Gorton has told us it happens usually during crises, okay? What do the trust companies do? Well, JP Morgan is trying to organize various emergency lending options for them to stop the panic. This keeps on going until early November, where he finally gets the bankers in his house, locks them in, literally locks them in until 3 a.m., where they figure out a big emergency bailout that gets injected and that helps, okay? So what you can see in this graph is that there is quite a lot of variation in how much deposits these trust companies lost. We're using quarterly data comparing August to December, okay? So we want to explain this variation, and I want to convince you that that variation is explained due to these connections to people in the scandal, okay? But as Fernando is saying, for this to matter, individuals, investors needed to know the identities of these directors and these connections, and that was extremely important. So I'm pretty sure that if I ask you today what the directors are of the banks where you have your checking accounts or your savings accounts, you have no idea. But this is how companies advertise. So this is from the Carnegie Trust Company, and what you cannot see here is that Arthur Hines, which was one of the speculators, was a director, okay? And this was well known. It became also very salient during the crisis. Immediately, companies started saying, well, the character of our directors is very good, and Carnegie Trust is actually very interesting, because during the crisis, they stopped publishing the names of the directors, okay? Association with Hines wasn't a very good thing. The one number that they published was the name of the president, which is Leslie M. Shaw, which had been the Secretary of the Treasury until March of that year. So trying to say, we're very good, okay? So this is the full set of connections. Now we have the 5 men at the center of the scandal, and we're gonna look at trust companies that are directly connected in the sense that one of them, at least one of them was a director in them, companies that have an interlock connection, so they share at least 2 directors with one of these trust companies, and trust companies that have what we call a deposit connection, which means that they're either depositing in a financial institution with direct connections to these men or holding deposits from them. So what we find is that these types of connections, if you had this type of connection, your loss in deposits was roughly 25 to 35% bigger. Overall, they explain 50% of the variation in deposit losses. And these coefficients are not affected if we control for balance sheet characteristics of the trust or for a proxy of the types of depositors that these trust companies have. So that is our point to try to deal at reverse causation. What we're gonna do effectively is we're gonna look at whether firms that were associated with severely affected trust companies suffer relative to other firms. We're gonna focus mostly on trust companies because, as you can see, their lending was roughly comparable to the national banks, and it dropped 40% during the crisis, whereas the lending from the national banks in New York continue roughly to be the same. We're gonna define severely affected as trust companies that were in the top 25% of deposit losses. So the first 8 bigger red bars that you saw in there. So very, very simple, okay? There are some differences in observables we can control for, but no differences in pretrends, and we do more of this in the paper. So let's get at some firm level data. The first thing that we do is we look for a stock market response. So this is sort of an immediate response. Do investors feel that these connections will affect firms? Okay, so we're gonna compare firms without and with the affiliations to trust companies, but we sort of expect, as in the cases in which there might be asymmetries of information, that the effects are gonna be great, heterogeneous, in the sense that smaller firms might actually suffer more if they're losing their credit suppliers or from a reputation effect than larger firms, okay? So just to put this in a very simple graph, so this is weekly data that we collected from price data from the New York Times, and we're splitting the firms in our sample into sort of 4 portfolios of small, large firms connected to affected trusts and not connected to affected trusts. And what you see is that the stock returns basically behave pretty much the same before, during, and sort of after the crisis for all portfolios, except for the small firms that were connected to affected trust that really suffer. Okay? So we can do it sort of in a standard sort of event study type of regression where we look at the cumulative returns for a firm sort of in a window around the panic, and we're going to have two terms that are going to be of interest. We expect that firms that are connected to an affected trust, so that they have at least one director from an affected trust that was in the top 25% of deposit losses, would have suffered. So we expect lambda 1 to be negative if investors actually perceive these connections to be detrimental for them. But we expect this effect to be smaller the bigger the firm is. So in everything that I'm going to show you, we're going to allow for this effect to vary with firm size. So we expect lambda 2 to be bigger. And if we actually wanted to look at the magnitude of the effect of the unaffiliation with an affected trust, we sort of have to look at the combined term. So that's exactly what we find, right? We find a negative lambda 1 and a positive lambda 2, so bigger firms do better. And just to give you a sense of magnitude, is sort of we look at this column in here. If you look at two industrial firms that are, say, of medium size, one that is connected to affected trust and one that is not, just purely on the connections, the connected firm would have seen at 60% lower cumulative returns in a 1-week window around the panic, okay? Now, this is, of course, we have one cumulative return per firm, so you might be worried that maybe firms that were connected to affected trust were generally different. So we sort of do a little placebo, and we look a little bit about a month before the panic, and we don't find the same effects, okay? So this is just illustrative, and it's telling us that maybe investors perceive something. Then we get to firm performance, and for this we're going to use accounting data that we collected from 1903 to 1912, okay? So this is going to be now annual data, and we're going to do a standard diff and diff, where now we look at the affected trust dummy, but we're going to look at the differential effect post-panic. And again, we're going to allow for this effect to vary with firm size. And we have annual data now, so we can have firm and year fixed effects if we want to. And again, we expect the connections to affected trust to affect these firms negatively, but affect smaller firms more. So that's exactly what we find. We find that profitability suffers for firms that are connected to affected trust. They cut their dividends that they pay. They experience a higher interest rate, and with this we have to be careful. This is an average interest rate that's calculated from income statement information. Okay, so this is not the marginal interest rate that you would expect to shoot up. And their investment rate also diminishes. Now, by how much? Well, we can look at the implied effects from our coefficients for firms of various sizes. And exactly as you would expect, we find that the effects are larger for the smaller firms, so firms, for example, in the 25th percentile of assets. And if you want to get a sense of the magnitude of these effects, we can compare these magnitudes, for the example, with the sample mean for each variable in 1906. These are all in percentage points. So just to get a sense, we can relate them to the mean. And what you find is that for most of these variables, the effect implies a reduction, or in the case of the interest rate, an increase of roughly between 8% to 22% relative to the mean in 1906. So moderate to reasonable effects, except for the investment rate, in which the magnitude of the effects is quite large, is about 50%. Okay? So let me move on to aggregate effects. What we do next, now that we establish that these firms suffer, is to look for duration of the effects. Right. So we are going to run basically the same regression, but we're going to allow the coefficients to vary in each year in the post-panic period. So all we've done here is we replace the post-panic dummy with year dummies, okay? And we can look at how these effects are changing for investment, okay? And what we find is that the effects are, again, bigger for smaller firms than for larger firms in each period. They're largest overall in 1908, which is when we expect them to be largest. The panic starts quite late in 1907. And they decline over time, But depending on whether you look at the smaller or the medium-sized firms, they tend to persist for 3 to 5 years. Okay? And this persistence is roughly consistent with the evidence that Shularic and Taylor, for example, have found for macro data where they claim that the effects on investment, on aggregate investment, last for about 5 years after a financial crisis against using a series of historical financial crises. Okay, so the last aggregate calculation that we're going to do is we're going to use these different estimates sort of in the same way that Chodorov-Reich did for employment or that Paravicini and co-authors did for exports to try to get a sense of how much of the aggregate contraction in investment can be attributed to the shock to trust companies. And given that we know that one of the large macro consequences of crises is a big contraction in investment, that's one variable, the private investment that we see really contract, it's perhaps surprising that we haven't before used estimates in this way. So what exactly are we going to do? Well, we can use these estimates that vary in each year in the post-panic period to calculate, so basically to translate the changes in the investment rate for each firm on a drop in investment, okay? So the way in which we're going to do that is we grab our estimates from our previous regression, our estimated coefficients, okay? We're going to multiply for assets to transform our investment rate into the investment drop, and then we're going to aggregate over all of the firms that we know we see that are connected to an affected trust, okay? To get an aggregate effect. So we do that for the small and medium firms in our sample, and their estimated change in investment is roughly 40 million. For the large firms, it's roughly 8 million. And we can compare this with the actual change in investment that these firms suffer in 1908, okay? And what we find is that the connections to affected trust explain roughly almost 50% of the drop in investment for the small and medium firms, very little for the large firms, okay? Less than 4%. Now, one problem, though, is that we have just looked at NYSE-traded firms. This is a very small set of companies in the economy for which we can get at least an income statement and a balance sheet, okay? But we went back to Moody's, and we saw that there were more than 500 companies that are listed in Moody's, other than this, that were connected through boards to the affected trust. For 274 of them, we were actually able to have some sense of their accounting information to be able to calculate the drop in investment. And for them, the drop in investment is roughly 80 million. So if we combine all of these estimated changes, we get a drop in investment of $128 million, which is a little bit over 18% of the contraction in investment of all corporations in the US, all non-financial corporations in the US, which was 700 million. Okay, so this is most likely an underestimate because there might be other firms that were also connected to affected trusts or to other trusts that also suffer. But it just gives us a sense of how important this credit channel might be for the aggregate economy. Okay, so if there is one number that you want to take out of the paper, I would say take this one. Okay. In the last minute, I'm not going to show you all the results, but I'm going to tell you something about mechanisms and what we do to appease us for selection. So as I said before, there are two potential mechanisms at work here. It could really be this credit channel, broadly defined, not just through lending, but also through underwriting and other services that these trust companies provided. Or it could be that the effects that we find could have to do with reputation. Now, we don't see in a systematic way lending or any other provision of services. We see that in some specific cases. So what we did is we look at those commercial banks. Remember that graphing connections were the individuals in the corporate scandal were connected to? Well, those commercial banks were probably very subject to the reputation shock, but they did not suffer losses because they were bailed out by the clearinghouse. We use them instead of trust companies in our regressions, and we find no effect, which is suggestive that what we're picking up from the trust companies is coming from the credit channel and not for the reputation channel. We also look at an earlier crisis to convince ourselves that our results are not due to the fact that maybe non-financial firms that are more vulnerable at the time of the crisis. So this is a type of unobserved fixed effect that only becomes salient in a crisis. So we cannot control for it just with firm and year fixed effects. Selected into relationships with the more affected trusts. And indeed, we find that that was not the case. Okay, so we're sort of quite convinced that what we're picking up is sort of a credit supply type of effect. So let me just skip the results, get to the conclusions. In the paper, we tried really hard, even though we have to be very careful in comparing over 100 years, because the economy and financial markets have changed quite a bit, to try to see what we learn from this historical panic in a sort of more general way. I'm not going to go through all of them. I'm just going to emphasize one, which is that what we saw in this panic is that this non-regulated side of the financial sector grew when the regulated one was quite constrained, and grew in a way in which not only the regulators and investors, but also the bankers themselves in that sector did not understand the types of systemic risks they were exposed to. And because of that, they did not have mechanisms for cooperation that the regulated sector had developed, and that probably exacerbated the degree of the crisis and the propagation of the crisis overall. Thank you.
It's really nice to comment on Carola Frydman's paper. I think this is an excellent paper. It's also nice to come back to the University of Chicago. I was a graduate student here a long, long time ago, but it's always nice to get back. So this is a really excellent paper on a very important historical topic, the U.S. financial crisis of 1907, and that was a very important banking crisis because of its size and its impact on the U.S. economy. It was a recession that was worse quite a bit than the one we are still recovering from. And it was also important because it was the last of the 5 big banking panics in the national banking era from 1863 to 1913. And it was the proverbial straw that broke the camel's back that set in motion the reform process that led to the establishment of the Federal Reserve System. Okay? So it was, you know, as Carola was telling us, the 1907 crisis was closely connected to severe distress to the trust companies in New York City, and that these trust companies were non-bank financial intermediaries, and in some respects they were parallels to the shadow banking system that precipitated the recent crisis of 2007 to 2008. And these trust companies, as Carol told us, were not protected by the unofficial lender of last resort at the time, which was the New York Clearing House. And when it was revealed that the directors of, or one director of the Knickerbocker Trust, and also other trusts were connected to a failed scheme to corner these stocks in a copper company, there was a run. The run on Knickerbocker on October 21st did not lead to a rescue by the New York Clearing House, and that caused it to fail. And that led to a panic withdrawal of deposits from the other trust companies. Okay? And then the trust company panic spread to the commercial banks in New York and then across the country. And then rescues that were arranged by J.P. Morgan, as well as issues of clearinghouse loan certificates by the New York Clearing House, and also that the U.S. Treasury was involved. And what the Treasury did was it would deposit customs revenues in the New York City banks, and sort of to try to take the pressure off. Okay, but none of those things actually worked to allay the panic, and it ended the way a lot of these panics ended in the national banking era, by suspension of deposits into currency, and that sort of took the pressure off. Okay, so the paper is really it's an excellent piece of historical research. It provides a unique and comprehensive database on the trust companies and the non-financial companies that receive loans from them, and it carefully documents how these companies lost access to valuable finance and reduced their investment spending. It's also an excellent example of research in corporate finance. It reveals the interconnection between the directors of the tainted, that's the term I use for trusts, and the commercial banks at the heart of the scandal, and between the trust companies and the affiliated companies. And finally, the paper makes a valuable contribution by identifying the role of the lending channel or the credit channel as the mechanism by which distress in the trust companies led to severe negative consequences for the affiliated non-financial companies. And I think that their identification strategy clearly isolates a lending supply shock. And also, as she told us at the end, it downplays any role for a reputation shock. Okay, so now in my comments, I'm not very critical of the paper. I think the paper is great, but rather I have some doubts about the because I've been doing a lot of work for many years on financial crises. I have some doubts about the importance of the trust companies for the crisis of 1907 and the recession of 1907 and 1908. So what the authors show in Table 5 is that the cutback in lending by the trust companies reduced corporate investment by 128.5, that should be $1 million, which is equivalent to 18.4% of total corporate investment, okay? So the question is this a big number for the US economy? Okay, so that was my question. And using the data from Balke and Gordon's work, we see that GNP, gross national product in 1907, was $28.8 billion. It then fell to $26.72 billion in 1908. Okay? The impact of the collapse in trust company corporate investment represented about 1/2 of 1% of 1907 GNP, okay, or 6% of the decline in GNP between 1907 and 1908. Okay, so it's definitely significant. Okay, but it does not explain that much of the close to 7.5% drop in GNP that occurred in the recession. Okay, so I wanted to just put that into context. Well, the main event of 1907 was an old-fashioned banking panic, and broad money fell by 5% from September 1907 to February 1908. This comes from Friedman and Schwartz, and it's driven by a drop in the deposit currency ratio as people rushed to get out of the banks and run into cash, and by a fall in the deposit reserve ratio as the banks scrambled to call in their loans and sell off their earning assets. And there were bank failures. Now, 246 banks failed. Okay, the number in terms of other big banking panics of the national banking year was actually a bit smaller, and it was half of what happened in 1893 because the clearinghouse rescues actually did do quite a bit. Okay, they did contain the panic, okay, compared to 1893 when twice the number of banks failed. Okay, so the question is that would there have been a panic without the collapse of the trust companies? And I argue that we would have had a panic, and the reason is because the shock which precipitated the crisis was a sudden stop of capital flows from the UK. So if you go back, the story of the 1907 crisis goes back to some other events. For example, the earthquake in San Francisco in 1906 that led to a big payout by British insurance companies, which led to capital flows from Britain and gold losses for the Bank of England. And so they tightened, and not only did they tighten, but they rationed credit to New York, to merchant banks that were lending to New York. Okay, and so what happened in 1907 was not that totally different from other crises in the 19th century. Okay, crises like 1837, 1873, and 1890. Because remember, the US was still an emerging market country. So a lot of the things that happened to the US in the 19th century are things that happened to Latin American countries in the 20th centuries and happened to them in the 19th century. Okay, so that's my main point, that this is like you got to put this in context. So then sort of just I want to conclude with just think about some of the policy lessons that come out of this paper and this discussion. So the first lesson is on the role of the lender of last resort. Now, if you'd had a Bank of England type lender of last resort in place, okay, so the Bank of England was the best example of how you're supposed to do things in this period before the Federal Reserve, because the U.S. did not have a central bank since the collapse of the second bank of the United States. So the U.S. was really quite unique amongst advanced countries, or almost advanced countries, in not having a central bank. So the Bank of England was the sort of the way, in a sense, many people would argue, was the way things should have been done. So if you'd had a Bank of England type lender of last resort in place, okay, the crisis would have been avoided. Because the way the Bank of England operated was they had this, in a sense, think of this frosted window, which had about a couple of inches below it. And there's this guy behind the window, and he's looking out, and people come, the discount houses and the commercial banks, but mainly the discount houses in London, come and they push paper underneath the window, the collateral. The bank looks at the collateral, is it good, fine, puts the cash underneath the window, okay? So if that had been around, if we'd had a Bank of England type frosted glass discount window, then the crisis would have been allayed, because all that mattered was the soundness of the collateral passed under the window. And both of the commercial banks and the trust companies would have been accommodated, okay? Because the commercial banks were near banks, and they did deposit taking, and many of them had pretty decent collateral. Now, if the Fed which was established in 1913, I mean the Federal Reserve back in 1913, if the Federal Reserve was in business, okay, back then the trust companies would have been out of luck. They would have not had access to the discount window, because under the Federal Reserve Act, only member banks had access, and the trust companies definitely were not members. And so it would have been just like in the 1930s, when the state banks and other types of banks could not access the window, and we had we had 4 terrible banking panics. So then we can ask the question, well, would the crisis have been allayed if the national banks had had access to the window? And that, of course, is an interesting counterfactual. I mean, I don't know the answer to that, but I suspect that if they had, that would have allayed the crisis, okay? And my second lesson, which is in concordance with the paper, is that shadow banks were important both then and now, okay? And that leads to the question, do we regulate, supervise, and backstop everything in the financial system? Or do we draw a line in the sand, in a sense, around deposit-taking institutions and the payments mechanism? So if we did that, if we think of the context of 1907, the trust companies, which were deposit-taking, would likely have been protected. They would have been inside the line in the sand, okay? But even if they were not covered, and the commercial banking system was, given the numbers that I calculated, the recession probably would have still been mild. Okay? Okay. Well, if we come to the current crisis, the recent crisis, 2007 to 2008, the shadow banks did not issue deposits, and they weren't part of the payment system. So the question is whether a traditional lender of last resort, which only protected deposit-taking institutions and the payment system, whether that would have prevented a panic. That's an open question. That's a question for debate. Okay, so I'll stop there.
Thank you, Michael, for those comments, and I really interesting policy lessons. I agree with them very much. Let me get at the big points in here. So the first point is that I completely agree that there are many, many other things that happened in the panic of 1907. It would be super interesting to be able to analyze the effects of the monetary contraction, for example, and the collapse of other banks. This is out of the scope of the data that we have. So a lot of those other banks that fail in other parts in the country. They would not be connected with the types of firms that we're looking at, but they probably played a big role, and it would be really interesting to analyze them. Now, the other point is, are the numbers that we're finding big or small? And here I want to make a couple of clarifications, right? And they have to do with the way in which we're identifying things and in sort of the identification police type of way. In many ways, we're stacking everything towards not finding much of an effect, right? So that's a problem if we want to calibrate something at the macro level, but it is the way in which we try to say, well, this is how much we can really claim it's causal, right? So we do that in various ways in the paper, and we're quite careful in explaining why we think what we're finding is an underestimate, right? So that's one point. The other part is that I don't know that I would take this estimate. So part of it is just by the way in which we set up our regressions. Part of it is because by looking at this diff and def, we're not considering general equilibrium effects or anything else that might sort of trickle to a bigger effect in the economy. We are just looking at investment. If you look at corporate investment, I don't remember the numbers, but it's not a huge fraction of GNP anyway. So it's a little bit hard to take this number, and I take your calculation, that's fine. But given that from what we're starting with, I don't find that at 6% explaining 6% of the decline in GDP to be so small, given what we're focusing on, right? Which is based on a very small number of companies, of non-financial firms. They're the largest, they're the NYSE-listed companies. They're going to be the least likely to be affected by the crisis in many ways, right? But as you say, there are a lot of other interesting aspects that, hopefully with more data digging, we can get at in future papers.
So can you tell us more, kind of really what happened in terms of these guys made sort of some shady investment, then they lost some money? And then what's the concern that people have? I mean, it was very fast. So do they have concerns that someone made the same investment, or they have concerns that are bad managers, or they have concerns that they have some other investment on the banks that on the other trust and you didn't? I mean, if you could just give more detail on.
So what they did is they basically tried to corner short sellers on this copper company, on United Copper, and to basically play that game, they used the resources of banks they control. So they took over national banks, and they just used the funds from those banks to speculate in the stock market. They couldn't corner them, so they lost a lot of money, and that was money from their banks, and the banks were in trouble, okay? So how that trickled to other companies, it happened very quickly, so part of that was panic. A lot of it we gather from reading newspapers and sort of anecdotal type evidence, and to the extent that we can see, a lot of those concerns are, well, we know that Charles Barney was the president of a firm in which Morse is, a bank in which Morse is a director. They're known to be related. He probably lent them money for the speculation. So a lot of the concern was that they had used resources from these trust companies.
So the counterparts.
That's what I'm trying to
No, they weren't in practice. That was
I know, but it's
speculation. There was the
totally
fear.
motivated by personal
Yes.
interest and research. So it's the
Yeah.
fear that there
Yeah.
were counterparties
Yeah.
on something
extent-
will lead them to pull out
Yeah.
the money.
Yeah, to the extent that we can see, and the only, for example, we can see that Charles Barney lent a tiny, modest amount.
When you're reading a newspaper, people thought it may have been like much
Yeah.
more, and that's why
And-
it's brought.
And they actually say that when they fire Barney, and in a lot of other banks. So the second trust company that gets severe runs immediately is the Trust Company of America. It's the second largest trust company in New York. And immediately the announcement that they make is that they're not at all related with these crooked individuals that did the scandal.
People run some of them.
They run on them, and TCA is the first. So JP Morgan basically makes the decision of letting Knickerbocker fail. And when they see the big run on TCA, they start pumping a lot of money, in part because TCA, if you look at my interpretation, this is completely my speculation. If you look at the non-financial companies that are affiliated with Knickerbocker versus TCA, TCA has the companies where JP Morgan was very important, like US Steel, International Mercantile, and so on, right? So he had potentially more of an interest to bring them up.
So related to that, because you use the word reputation in two different ways. I mean, you refer to reputation in the paper as the firm's reputation of dealing with a particular bank. But I was thinking that there is also a reputation type of mechanism through the director of the bank.
Mm-hmm.
So if a particular director of Knickerbocker was related to another bank, that sent a signal about the soundness of the bank that particular manager was related to.
Absolutely.
So
Yeah.
the reputation, is it fair to consider that there was a mechanism of reputations and learning at the director level? But that's not the reputation that you're talking about.
It could be the way in which we're thinking about that second reputation. It's interrelated. It's the idea that you are a non-financial firm, you have as directors that might be providing you with advice actually. So bankers on boards, which are not common in the US now, were incredibly common at the time, okay? 70% of the large companies at the time had a banker on the board. Completely different governance than what we see now. And these bankers did much more. They were much more active than we would think. So the way in which we think about that second reputation channel is to say, well, you have directors that's supposed to be providing you with advice. In many cases, they might even change your managers and so on. So they're quite active. And these guys are of bad quality, in a sense, right? So what does that say about your firm? And that's why I think about that second reputation channel, that in the part that affects the non-financial firms, in a sense, as a particular case of a balance sheet channel, right? It's not credit. It's basically the banks don't lend you, not because they're constrained. It's because they now update it on your quality. Yeah, so they're both operating.
So this is like very, very cool. I have like one question on interpretation there, which is the following. I kind of knew this that the US had like a bunch of sound stocks and looked much more like an emerging market. So suppose that one way in which this could have played out is that these guys, here's the alternative, sorry, these guys are the guys who are like very financially sophisticated, right? And they self-select, so their companies select them. And the sort of strategies that they propose to those companies are strategies that rely a lot on like a healthy credit flow from abroad, like very risky stuff and all that. So when the crisis actually hits, those are the companies who are going to get the biggest problem.
So the one final robustness that I didn't manage to show, so we're worried about this generally, right? So we have firm fixed effects and year fixed effects. That's fine for firm characteristics that are not salient in a crisis. But what you're saying is this is salient in a crisis, right? Because you have a standing stop at that time. So these are what we call time-varying unobserved firm characteristics that could do with sort of how dependent you are on this, or are you more sensitive in times of crises? So this is sort of one. I can't really deal with it because I don't know how dependent they are directly. But what we've done is we look. This is why the fact that the US was so unstable at the time, it's very helpful for us. So there was another panic in 1903 and 1904. Very, very close in time to the panic of 1907. It was much more moderate, so it wasn't quite as severe. But what we do as a robustness is we look at exactly the same companies, right? So we keep the affected firms, non-financial firms, the same, and we look at whether they suffer in all of the various variables that we looked at during that panic, and they don't, right? So if it's something like, well, it's a sudden stop that might affect in both panics, so that should appease it, right? Now, of course, the underlying assumption in there is that the firm fundamentals did not change from 1903, 04 to 1907, so it's what we can do.